George, or Jorge, he tells us he happily answers to both, is our tax member in New York. He's got a JD from Georgetown and an LLM in taxation from New York NYU School of Law. He is part of the Rodriguez Law Firm with offices in New York, offering specialized tax law advice, including international, federal, state, and local taxation, tax controversy, and commercial litigation. He is a wonderful member of our chapter, and I hope you enjoy his presentation today as much as we enjoy having him at our meetings.
Thank you very much, Jane and Annabelle, and everybody else who helped in putting this presentation together. It's a real honor to be part of the INBLF network and to be part of this team. I've also really enjoyed the presentations that I've been able to attend up to this moment. I have found them to be useful and very interesting, and I hope to try my best to make this presentation, which is tax, always interesting but a little complicated, make it fun, but most importantly, make it useful to all of you, my colleagues, and your respective clients or prospective respective clients. Just a quick note about myself. I went into tax about 2 decades ago. I went to DC to do international, or what I thought I was going to be doing, international law. And I met, amongst other great luminaries, Marty Ginsburg, the late husband of Ruth Bader Ginsburg, and the rest is history, or tax history, as they say. He was a corporate tax expert at Georgetown Law, and we had many other people of his stature. So that's why, or that's a big factor as to why I got into tax. And it has been an incredible journey, lots of fun, lots of changes and moving pieces in this niche practice of the law. And I will say this, as a knowing a lot about how non-tax colleagues perceive tax, it's a very, very specialized, very niche, very sort of focused, which is obviously true. But the reality is that once you're inside the tax universe, as I call it, you find that there are many galaxies, many solar systems, and they all interconnect with each other, although they have different rules. These systems, whether we're talking about international, whether we're talking about federal, whether we're talking about controversy or litigation type, audit defense versus planning. So, the goal of this presentation is to just give you, my fellow INBLF colleagues, a sprinkling of some of these different galaxies, as it were. But of course, starting with the Biden administration's tax law agenda and going over some of the points or some of the specific things that the Biden team is seeking. I want to get through a lot of materials. But feel free to jump in with questions, which I will try my best to answer, or we can set up, if the question is very technical or if it's somewhat sensitive or whatever, we can set up an offline meeting. I'll provide my contact information in the last slide. I would do it now in the chat box, but I want to be careful. I'm more nervous about losing the slide sharing, the screen sharing here than anything else. So I'm going to leave things as they are in terms of that. But in any event, if you have any specific questions, feel free to ask as we go through these. I may jump around the slides at some points, but I'm going to try to keep it on track to the best of my ability. So I'll start with that. First disclaimer, obviously none of this is tax or legal advice. Just bear with me 1 second. Let me move my screen of you guys so I can see my screen. Okay. And Annabelle, if there's any issues with the slides or anything, just let me know. Feel free to chime in, or Jane or anybody else. So I just want to read some of these tax quotes, which I love. I always come back to these, and I'm sure many of you have heard some of these. So the first one is obviously the classic from the New Testament: render unto Caesar's that which is Caesar's, a classic that's always a goodie. The famous one from Ben Franklin: nothing in this world can be certain except death and taxes. And I think George Washington was also reputed to have said that. And that's certainly true. We're going to actually go over some of that as we go through some of the proposed changes for estate taxation from the Biden team. Here's one of my favorites that a lot of non-tax people have not seen. This is a classic quote from the great Judge Learned Hand. And I'm going to read this because I think it warrants reading. Anyone may so arrange his affairs. Of course, this was a couple decades ago, so excuse the patriarchal language. Anyone may so arrange his affairs that his taxes shall be as low as possible. He is not bound to choose that pattern which will best pay the treasury. There is not even a patriotic duty to increase one's taxes. That was a dissenting opinion in a famous case, but nevertheless, the maxim or the axiom that he sets forth there has remained true and ever more important as tax systems become increasingly complicated. And then to go on the other side of the spectrum a little bit, the great Justice Holmes, taxes are what we pay for a civilized society. And I'm really interested in the history of taxation and finding principles of taxation, whether from the Bible or from ancient Egypt and other ancient sources. So it goes all the way back, obviously, to our Constitution. A lot of tax provisions in the Constitution or that affect tax provisions, which I'm going to come back to in a couple of minutes. The power to tax involves the power to destroy. That was the famous quote from Justice John Marshall in McCulloch versus Maryland, which we all studied a long time ago. Always a goodie. And last but not least, the great Albert Einstein, the hardest thing in the world to understand is the income tax. So there you have it, some great quotes to start off with. So our agenda for today is to provide a summary overview of the Biden administration's federal tax legislative agenda. We'll go over some IRS enforcement trends. We'll touch upon international. I had a lot more, and then I peeled back because this was an hour presentation. I probably have slides here for a couple of hours, but I'll keep that one a little bit short, and we can continue conversations offline if necessary. There's a lot going on in the international arena. State and local tax, or as people now increasingly say, SALT. Many years ago, if you told a federal tax practitioner, hey, what do you think about the SALT implications of this transaction, they may not know what you were talking about. But the importance of state and local tax has only increased as we move forward with tax administration. And then, of course, last but not least, practical considerations. And I'll make a commitment to jump to that if we start getting short on time. I feel strongly that it's important to give away some practical insights and thoughts that might be of benefit to all of you and your clients. One more disclaimer, a lot of the information relative to Biden's tax agenda was derived from campaign materials, and then of course the post-election transition tax plans once the election was finalized, which obviously wasn't actually finalized until much later in the game, this particular election season. So as we all suspect, some of these plans, some of these tax plans are probably further along, and they're probably specific tax agenda items that haven't been released yet, like in the Biden-Harris transition team plans that they released in early mid-January, I want to say. So anyway, some of this information is based on that and only focuses on some of the tax items. There's just way too much to cover, even at this tentative preliminary stage. So let's start with COVID relief. As we all know, or most of everyone here knows, the Congress is focused on getting additional COVID pandemic relief legislation passed. There was a bill that was passed in December, it was enacted December of 2020. I'm going to come back to that piece of legislation in a different context. One of my colleagues Rocco presented a couple weeks ago on some of the details of, the specifics of the COVID relief package passed in December, which includes eligibility for additional rounds of PPP funding and so forth, and different changes in the parameters. I'm going to bypass that unless someone has some compelling question on that. I'll try my best to answer it. But I want to kind of focus on the agenda moving forward and what Congress and the Biden team is hoping to accomplish. So we've all heard the 1.9 trillion figure. We have now certainty as to the makeup of the Senate, which was up in play up until very recently. So we have a 50-50. It looks like they're not using the power sharing agreement in the Senate that was used the last time we had a 50-50, which I believe was 2001 when President Bush came in. So that's going to change the dynamics and allow the Democrats to, shoehorn legislation much easier in a sense. But what we know is that the committee chairs in the House are certainly working on pandemic relief legislation. We know that the Speaker and other committee leaders have looked at and have been very explicit in putting on the table that the reconciliation process and other similar procedural tools are on the table for fast tracking. And I believe a few days ago, there was confirmation from both chambers, once Schumer and McConnell figured out the power sharing agreement, to actually move forward with budget reconciliation procedures. Here's some thoughts. Bypassing the filibuster process in the Senate via reconciliation often increases the probability of hastily or poorly drafted tax legislation, requiring, of course, further corrective legislative action down the road, which, as we all know, whether or not you dabble in tax, that further increases the chances of complexity in the already very complex tax code, and probably decreases the probability of bipartisan efforts to enact corrective legislation later on down the road. But nevertheless, the politics are what they are. That being said, I would say, and I don't have a magic information on the inside in terms of the key committees: Joint Committee on Taxation, Senate Finance on the Senate side, and House Ways and Means on the House side. Those are the main legislative bodies that deal with tax. But we could probably, with confidence, make some overarching points. One is that it may be politically difficult for Congress to enact revenue-raising legislation in the short term in light of the ongoing economic fallout from the pandemic. So there's a push and a pull with that, and probably even without the need for peeling off a few senators from the Republican side, it still may be politically difficult to do too much on the revenue-raising side. Although it's all these predictions are speculative. But there are numerous tax legislative items on the table, any of which can have a big impact on taxpayers. And an additional point I want to make is that the issue of retroactivity comes up a lot with tax legislation, both on the federal side, on the state side. I'm going to say a little bit more about retroactivity later on when I get into the state tax component of this presentation. Retroactivity is a very interesting issue. We know that tax legislation, even passed late in the year, often is made retroactive to the start of that specific tax year, and that's been upheld, by the Supreme Court. But from a practical matter, it's generally preferable from a legislative point of view to if you're going to have revenue raisers, to have them in there earlier in the tax year rather than later, in order to avoid the pushback from retroactively going back to the beginning of that specific tax year. So that might be an argument in chamber for looking at some of these legislative proposals that look to increase taxes right away or eliminate deductions, etc. So let's just briefly go over the current lay of the land in terms of tax rates. Currently, there are 7 tax brackets: 10%, 12, 22, 24, 32, and 35, and 37% applicable to tax years beginning after tax year 2017 and before. These are all set to expire or sunset, as we say in tax legislation. They're supposed to sunset in 2026. But obviously 5 years is a long time, and there's going to be pressure to definitely make modifications to these rates And the Biden team, sure enough, has proposed and has called for increasing the top individual bracket, to 39.6 for taxpayers earning more than 400K. That would bring us back 39.6. I think would be exactly what we had as our top rate during the Clinton years, or the second term of the Clinton years. We were at 39.6, give or take. So, in terms of using the past as a reference point, not so different from what we've had relatively recently. But nevertheless, a sizable jump for those in the upper brackets. And of course, all of this would require adjustments of brackets at rates below the top rate. But I think the Biden plan is focusing on that 400K as a critical a benchmark. Let's do a quick look at capital gains. There's so much to be said on this. It gets complicated very, very fast. But
before you leave, can I ask one question?
Sure.
On your last slide, can you put it back?
Sure.
You talk about income. I've understood that the Democrats talk about gross income, adjusted gross income, and taxable income as separate items. And that one of the things directed at the Trump type people is to make sure that taxes are paid based on gross income, among other things. Is there any discussion of that contemplated for the forthcoming year?
That's a great question, Patrick. I'm not aware of, and that doesn't mean it's not out there, but I am not aware. And obviously, I looked at a lot of things in preparation of this presentation, but I'm not aware of a specific bill or a proposed bill that would begin to tax income on a gross level rather than a net income level. But when we touch upon wealth taxation, which I'm going to come to in a few minutes, there you have a semblance of that concept, right? Where you're basically looking at taxing accumulated gains, even though you don't have what's called in tax law a realization event. You don't have a sale or a transfer or a disposition of the asset. That being said, there's a lot of effervescence, in this space, and a lot of dynamism. So it's certainly possible that we could see increasing calls for things like gross income taxation. That would be tectonic. I think, my personal view, that would be a tectonic shift. We've had a net income tax system in this country for a long time, with a few notable exceptions. The states have, in some instances, gross receipts taxes or similar types of taxes, but that's in a different context, and it's somewhat different than what I think you're talking about here, which is, I think what you're saying is, what are the chances that there's going to be legislation that, at least for upper brackets, starts to tax people on a gross income level? And with mark-to-market proposals and some of these wealth tax proposals, there could be sort of indirect ways of at least some people in Congress trying to get to that, with what you're saying. But I don't think... Without
getting too technical, what I'm really asking is whether they change the recognition rules as opposed to match more the realization rules.
Well, that's what I was referring to a couple of minutes ago.
Right.
The idea behind, say, the wealth tax proposal that Senator Warren has been pushing for a while is along the lines of what you're saying, where the concept of realization is thrown out. But even under Senator Warren's plans, at least when she was a candidate, I don't know where she is now, the idea was that would be in excess for people in excess of 50 million. So the chances politically or legislatively, in terms of the moving pieces, even with Dems having control, I don't see it as particularly likely at this particular juncture. But hey, anything could happen in a sense, right? So thank you for your question, Patrick. And we could continue the chat offline. So let me keep moving through this. So current capital gains tax rate. So currently, as many of you know, or vaguely recall from a few years ago, we had the TCJA, the Tax Cuts Jobs Act. I'm going to keep referring to that as the TCJA, or the Trump tax law from 2017. So currently the top capital rate is 20% for net capital gains in excess of $441,450 for single, almost $500K for married joint filers, close to that for head of household, and a little lower for married filing separate. Then you have, in the current system, you have a second tier at 15% for capital gains below those thresholds I just articulated, but above 80K. And then for capital gains for income below 80K are not subject to capital gains taxes, generally speaking, currently. Notable exception, which is good for you guys to know. Some of you may have clients that, you know, they have what's called small business stock under Section 1202 of the code. And for that and for collectibles, there's a different rate of 28%, but with a lot of exceptions and different planning devices that can be used in those scenarios. And then probably most of you know the net short-term capital gains are going to continue to be taxed as ordinary income under the current scheme. So let's take a look at what President Biden is thinking, or has again expressed thoughts on this throughout the campaign and through his transition plan. He would seek to tax capital gains at the top ordinary tax rate. So again, 39% or so for, again, taxpayers with income in excess of 1 million. So this would be a quote unquote progressive or graduated tax rate for upper income brackets for those individuals who have capital gains. They're looking at, the Biden team wants to possibly reform these qualified opportunity funds from 2017. That basically, I don't want to get into the mechanics of those, but basically there were funds that allowed investors to derive significant tax benefits from investing in these funds that targeted monies for development, real estate development in low-income communities or communities targeted for economic development and so forth. And I think one of the things the Biden administration wants to do is maybe keep these funds, but put a lot more strings into them and require the funds and these different real estate groups to work to show more metrics in terms of the purported objectives of economic revitalization or keeping diverse income people in their homes, etc. And basically requiring these funds to work closely with nonprofit organizations and require them to engage in more public disclosures of their investments. One more point about capital gains that I think is very important, and this dovetails with Patrick's comments a few minutes ago. Senator Wyden, who now is arguably the most powerful tax person on the Hill, because he's now the chair of Senate Finance, he has specifically and explicitly articulated he has said he wants to stop or limit tax deferral on capital gains for these higher brackets and implement a mark-to-market system on accrued capital gains. This is a little bit different than Senator Warren's wealth tax proposal, but you see a lot of similarity there, where there's this trend of looking at doing away with the realization concept, which has been, once again, part of the U.S. tax system federally, and the states piggyback off the feds. Realization has been required from the beginning, from the 16th Amendment, which set forth the origins of our income tax, and from the early cases requiring there to be an actual realization, right? You actually have the taxpayer, whether it's a trust, whether it's an individual, whether it's a business, has to have an actual gain that flows through and materializes to them from sale, from transfer, etc. There are a few interesting exceptions to the realization requirement in our current tax system. Notable mention of our current rules for expatriates, namely for those individuals who give up their U.S. tax residency status. I'll come back to that in a couple of slides when I mention expatriation. But the point I'm trying to make is we haven't had a, I think this, what I'm trying to say, this might be the closest we've actually come legislatively to have a mark-to-market type of system. Maybe there's a few other counterexamples out there, but as far as I can recall, this is pretty, this is more likely. So we'll see what happens. We'll see if this becomes law. Maybe not now, as I mentioned early in the presentation. The dynamics may not allow some of these things, some of these revenue raisers, but there are things to certainly keep an eye on. And no less than the Senate Finance Chair thinks it's a good idea to do a mark-to-market system. Which, just one more thing, the mark-to-market system requires basically the taxpayer to submit a valuation of the portfolio, whether it's a business or an individual or otherwise, to at the last day of the calendar year, the fiscal year, or what have you. There's different ways of doing it. Basically, to take a snapshot of the value of that specific asset. Let's say stock in a publicly traded company, or maybe a privately traded company. Private company, and then to net that against the cost or the basis in acquiring the asset, and then to report all of that, and then to pay tax on that. So, kind of important and kind of big, but we'll see. Brief, very, very brief. I want to move on. This is just kind of along the lines of my interest in the history, tax history, and the history of different things along the way, different legislative moments. And we've had the tax code for about 100 years, and we've had a preference for capital gains taxes in the code for a coterminous with the existence of the code itself, about 100 years. There have been many prior attempts at repeal of the capital gains tax, all of which have failed, except, I believe, there might be some tax nerd, some tax colleague nerd in the audience that maybe could give another example. I think there's one from the 80s where they managed to agree to just repeal that preference for a few years, and then it went right back during the Reagan years. And here's an interesting thing, without getting too technical as to the policy arguments, but the policy arguments, the main ones, have been around for about 100 years or 80 years. Certainly, if you look back at Secretary Mellon, Andrew Mellon, the great philanthropist and entrepreneur, he was Treasury Secretary for a while, and you read some of his writings on this question of, should capital gains be taxed at a preferential rate? You come out and you see different counterintuitive points that just belies the right-left, liberal conservative dichotomy that we're so familiar with in this highly politicized environment we're all living in. So let's come to wealth taxes. Current law, there's no direct taxation on the accumulation of wealth. I'm putting aside estate and gift taxation for the moment. Outside of the tax expatriation context, which I mentioned, that's 877 of the Internal Revenue Code. The wealthiest taxpayers are obviously subject to estate taxation based on whether they surpass the various exemption categories, but there's no direct wealth tax in the U.S. right now. And once again, Senator Warren is looking at doing exactly that for net worth in excess of $50 million. One very notable thing, which some of you may not have seen because this just happened a few days ago, Senator Warren was appointed or delegated to the Senate Finance Committee. So she was not on that committee before. She was on different powerful committees, but this is the key committee for tax legislation. So For those of you who are worried about wealth taxation, direct wealth taxation becoming a reality, we're now arguably one step closer to that. Carried interest. This is most of you have seen this in the news, Wall Street Journal, and even publications like the New York Times writing about this topic. Under current law, income that flows to general partners of private investment funds is considered carried interest, is taxed at lower capital gains rates relative to ordinary income. Carried interest tax benefits allows the managers to receive a profit, for example, in a partnership, and they perform services. And there's usually a holding period, and then they get capital gains treatment when the interest or the asset is sold later on in time. Biden is looking to eliminate that benefit. Taxation of cryptocurrencies. So interesting and so much to say about this, and I can't believe it's already almost 3:40. Cryptocurrencies, they're a red hot financial asset, as many of you might know. It's a hot investment topic, and it's a hot tax topic. It's a type of virtual currency that uses cryptography. I'll spare some of the details. It allows an exchange of value. Under the current tax rules, virtual currencies are currently treated as property for tax purposes, and the general tax principles applicable to property transactions that we're familiar with apply to transactions using virtual currencies. That's relatively new. The clarification as to those things from U.S. Treasury, from the IRS, and other state tax and other tax authorities, including states. Gains from the sale of cryptocurrencies are treated as capital gains. The IRS, this is brand new, is requiring the reporting of income from cryptocurrencies on the 1040 itself. That's relatively new, or brand new, I think, for the 2020 tax year that is now upon us for filing purposes. And 8949 has to be filed as well. Basically, the bottom line is it must be disclosed. In fact, all taxpayers, all U.S. taxpayers will have to disclose whether or not they have virtual currencies and crypto assets. In terms of the Biden team, as to best of my knowledge, they have not called for a specific type of taxing of cryptocurrencies, but this is definitely an item to keep an eye on. In my view, I'm not an expert with these things, but I do think as the dollar declines, which we've seen a significant decline of the dollar, then the tax authorities become more interested in crypto assets, because as we all know, the dollars assets find their way into other asset buckets or asset baskets. Anyways, taxation on financial instruments. This has been percolating. It's one of these hot political items. Under current law, there's no federal tax on going into a transaction, whether it's buying or selling stock or derivatives, options, and other financial instruments. The Biden team does appear to support some legislation for some transaction tax, as it's called. We know, without getting too political into this, we know that some of the European countries tried transaction taxes on financial instruments, then walked it back. So again, we'll see what happens in terms of the dynamics on that, but that's on the table legislatively. Quick mention on corporate tax rates. As probably most of you know, the TCJA from 17 got down that rate to 21% from formerly 35. That's a big spread, 14% spread, and changed the world of federal and international tax planning significantly in terms of the delta on the rate. The Biden administration, I think what they've announced so far is a 28% corporate rate number with, and this is very important, a 15% minimum book tax on companies reporting in excess of 100 million, but who paid zero or even negative income tax rates, meaning they got refunds or credits for foreign taxes paid. Basically, that's an indirect way of saying that the proposal would limit NOLs and other beneficial tax attributes that taxpayers are entitled to under the law. I mean, NOLs have been in existence for a long time from both Republican and Democratic administrations. So when you talk about something like a book tax, that's also along the lines like wealth taxation or gross taxation versus net income. That is tectonic. That is paradigm shifting. That's one of my favorite words. Paradigm. I mean, we're in this age of COVID of paradigm shifting. So probably we're going to see a lot of paradigm shifting in taxation. This is one of those things. I haven't seen too much pushback or even commentary necessarily on that. I could have missed it, but that's out there. This would obviously hit middle market companies. This is not only directed at the top 5 tech companies, which are being targeted very aggressively, but this would go after middle market companies and basically deny NOLs or deny them deductions and get closer to a gross income type of model, which was what Patrick raised earlier in the presentation. So we'll see. I've seen 25, 26% floated around in the few things that I've seen in terms of what is being discussed on the Hill side, but the Biden team has articulated 28%, which is lower than it was a few years ago, but it's higher. It's higher than where we are now.
Quick question before you leave that, Jorge.
Sure.
Is that 100 million revenue? Gross revenue?
I believe so. I don't remember off the top of my head. I have it here in my materials.
Could be taxable income. It's not taxable income before foreign taxes and carryovers.
Basically saying what's on book, which we know there's differences which get very complicated between a company's book income and their tax income. But what they're basically getting at here is, you're going to get much, if you're not paying at least, if you're a company, you're a multinational, you're not paying at least 15% of corporate tax. If you're a C Corp, then we're gonna basically make you report to the IRS what your book numbers are, and pay tax on that if you meet these thresholds. Thank you for your question, Patrick. Expatriation, I love this topic. It's somewhat out there in terms of the non-tax press, but it'll be out there even more is my humble prediction. So expatriation is when, so the starting point of a real conversation about expatriation is the following observation. The US is one of only a handful of countries in the world that taxes US tax residents on worldwide income. And every lawyer should know that. Even if you're not a tax lawyer, you don't deal with tax at all. Most of you probably deal with things that involve tax at some point. But in any event, it's worldwide taxation. And many of us have foreign clients. My firm has clients from all over the world: Asia, Latin America, Europe, Africa, and there's sometimes a lot of initial tax meetings with prospectives or with actual clients is spending time on this and just walking them through. And you want your company to become a U.S. Tax resident, or, whether it's forming a subsidiary here or otherwise, or you yourself want green card status, for example, then you're gonna owe taxes on a worldwide basis. How can that be, right? And this has been a big sticking point in the global tax system for many, many years. As an aside, many other countries now have looked at things in a different way. Rather than fighting the U.S. or rather than saying the U.S., the global imperialist tax system or whatever, let's join them. You can't beat them, join them. And we saw that with FATCA, which I'm not going to get into. It's too much for this presentation. That's the Foreign Account Tax Compliance Act from the Obama years, where instead of other countries pushing back, they said, you know what, we're going to help the U.S. report foreign assets or foreign accounts, etc. But we're going to do the same thing. So you have countries like Colombia that 20, 30 years ago would never have even, thought to join the U.S. with these things, has now got their, what I call mini FATCAs, and many other countries in Europe and elsewhere. So that's the starting point for any conversation about expatriation. So with increasing budget deficits, and most people recognize that taxes are going to go up, whether it's now, whether it's later. Taxes are going to go up probably very soon in the next couple of years with the Biden administration. So expatriation, I should say, was increasing even under the Trump tax years, and that could be for non-tax reasons. We've all heard people say they want to leave the U.S., they want to go to Canada, they want to go elsewhere, they want to go to some island and forget about the mess here. So the expatriations are increasing, and the U.S. Treasury publishes a number. The number is like up to 5,000 or 6,000. It's getting up there. It used to be like 1,000 or 2,000. My firm has handled some of these cases, and they get very, very complicated. One of the reasons they get complicated is because immigration attorneys, which are typically handling these expatriation cases, don't necessarily know that expatriating for U.S. immigration purposes does not entail or does not mean expatriation for U.S. tax purposes. And my firm has dealt with these cases where it was done maybe correctly for immigration law purposes with Homeland Security and so forth, but there was never there was not an expatriation tax that was paid. And this goes back to market that we were discussing earlier. And that's also for green card holders. There are a lot of folks who want green card status for a few years, and then they want to give that up again. They want to go back to, if they do business in the U.S., then they'll pay tax on U.S. source income, or they'll take benefits under relevant tax treaties. So anyway, so that trend is going to continue where people are going to be seeking to expatriate. And I expect Biden has not specifically called for a change in the rules, but I expect there to be much more enforcement in this area, aggressive enforcement. And you have clients that are thinking about doing it, again, whether for individual citizens or green card holders, they should meet with a tax lawyer and look at that very carefully. Estate taxation, under the current rules, 11.7 is the exemption category. For 2021, that was up from a little bit from last year. Most of us know, right? You get a step up in basis at the time of death for certain assets in the decedent's hands. Let's see. Biden is looking at increasing the top rate to 45%. We're currently at 40. If you pass the thresholds, which is much higher under the TCJA, and which, FYI, is set to expire anyways in a few years. So even if the Biden team doesn't get something passed with the state taxation, you're going to have a sunset kicking in a few years. So you have an automatic revenue raiser there. But in terms of practical, now may be a good time as ever for clients to review their wealth and succession planning and do a careful analysis of asset transfers. With the eye of the estate tax brackets, the exemption categories being reduced, and therefore estate tax picking up a lot more people, and in terms of the rate and otherwise. I'm going to skip child tax credits. The point there is Biden's looking to give some refundable child tax credits and EIC, earned income tax credits. I'm going to skip that. Employment taxes, the one thing I'll say there, sorry, Jane, I'll say more another time when we have our chapter meetings or otherwise, but the one thing I'll say there that is something to keep an eye on, even if Biden wasn't looking at it, which I think they are, is the classification or misclassification of employee versus independent contractor. I think there's going to be a lot more scrutiny in that space. So have your clients be aware of that, or help them with that, or send them to tax counsel to assist with that. There's an 8-pronged test, many of you know, for a long time in the federal tax authorities, but I expect enforcement and legislation and/or regulation in this area to increase significantly. Okay, wow, SALT cap repeal. Here's what I'll say quickly on this. Currently, we all know from TCJA, there's a $10,000 cap. That's a tectonic, what I would call a paradigm shifting event in tax. That's currently set to expire in just a few years, 5 years from now. There's a lot of proposals. That's a hot topic in the Northeast, obviously, and then you throw in California. For sure, some in Congress have specifically called for using a reconciliation to get this done. And as most of you know, Schumer is a big advocate of repealing the cap for obvious reasons, and he's now he's got the gavel in the Senate, so he has a lot of pull on this issue. But we'll see what the dynamics are. If it doesn't go through now, my prediction, don't quote me on it, but my prediction is then maybe later on in the year, we'll see some more realistic movement for some modification, maybe not full repeal of the SALT cap. But there's a lot of legislation out there, including one that I was taking a look at a couple nights ago. It's very interesting to repeal retroactively. So that's fascinating. It would cause a nightmare in terms of tax complexity and compliance. There would be opportunity for refunds for many of us or for many of our clients. But we'll see if it gets repealed, if maybe retroactive is too much, maybe it's just on a moving forward basis. One more comment, this came up in our chapter meeting a couple weeks ago, and I didn't have an answer. I think Joan asked about why doesn't New York have a workaround rule? And I said, I have to look into it. I said, I'm not sure. I think as of just a few days ago, Governor Cuomo put forth a proposal that would put into place a workaround on the SALT cap, similar to Connecticut and some other states, including some so-called red states. This is not just a blue state issue in terms of the workaround. And in a nutshell, without getting too technical, the workaround is that the state will have a straw or a fake. I call it fake, and I'm laughing because it's not funny when the states then decide it's no longer a workaround. They're just going to impose their own state taxes on pass-through entities, and I see that coming. So the lesson there is be careful what you wish for, right? A lot of us, or a lot of in the taxpayer community, were clamoring for some relief. The IRS passed a notice a few days ago blessing these workarounds that allow partnerships, whether large or big, to bypass the cap through this mechanism of the partnership to flow through the benefit at the partner level. If the SALT cap goes away, then that would moot, for instance, Governor Cuomo's proposal. But again, be careful what you ask for. I predict that these workarounds are going to be an entryway for states to impose more entity-level taxes on pass-through entities, PTEs, right? So that the differential of going C Corp versus partnership or C Corp versus S Corp, that differential is going to start to matter less in terms of state taxation. But we'll see. We'll see what happens. This is fascinating. Congress forced, one more comment on PPP. I know many of you have an interest in this area. Congress forced the IRS to allow deductions on expenses used by businesses, by loans that were forgiven by SBA. So it's basically double dipping. And the politics of the situation are such that, trade groups and others clamored and it got enacted, and now you could basically double dip. So there you have it, some economic stimulus. Okay, let's do quick enforcement at the IRS trends. a lot of delays in terms of getting these payments, relief payments, a lot of delays on refunds, so plan early. One more thing to mention in terms of trends, I think this is a very positive trend. As a tax lawyer, I think this is a good thing. More acceptance by tax authorities in general for taxpayers to file filings with digital signatures versus wet signatures. So I think that's a good thing for taxpayers. The IRS, I know for certain, I spoke directly with the commissioner, Chuck Redding, who I've known for a long time, on this very issue. The IRS has engaged, not widely reported, but it's out there. The IRS before COVID hired a lot of people, revenue agents and Office of Chief Counsel and otherwise. So they've ramped up, even though the IRS has taken a big hit like most institutions, right? Because of COVID and getting used to working from home and so forth. The overarching comment I'll make in terms of the impact of COVID on administration is we definitely saw a big slowdown with enforcement, whether audits or preliminary investigations early in the pandemic and then mid 2020. But as we approached the fall and as this strange world became more normalized, as it were, the IRS also ramped up its enforcement activities. So I'll come back to that in a minute. Here's a list of all the forms that can now be filed digitally that never was allowed. This is a huge point I want to make. The IRS is aggressively, all the way from the top, aggressively embracing AI, data, analytics. They have significantly increased their capabilities in this space. They're leveraging intra-institutionally and then working with other institutions, including other U.S. government agencies, and not widely reported yet, the tax authorities are working closely with private actors, right? With tech companies and other marketplaces private marketplaces for information, whether it's tracking, location tracking, right? Who's in your network on your devices and all of this stuff. And this is not going away. This is whether it's a Biden administration or not. This is here to stay. In fact, this platform picked up significantly under the Trump tax administration. So, the debates, the political debates around tax policies, once you peel it down at a deeper level, you see the glibness, for lack of a better term, of a lot of what's said out there. Because anyway, so now my firm, we get into some of these constitutional cases around these things, more on the multi-jurisdictional tax side. But in terms of AI and data analytics, huge opportunity for the IRS to close the tax gap. Okay, the so-called infamous or famous tax gap. That's the difference between, right, what the estimated amounts are that the IRS doesn't collect in any given year. So we know that this is going to help the IRS, and they are using it. On the other hand, we also know that there's tremendous, privacy concerns and constitutional issues at play. I personally am not satisfied as a tax attorney that cares about these issues. I'm not satisfied that there has been sufficient attention paid to this from the top at relevant agencies, including Homeland and Treasury. But this is happening, and there's been some scaling back. And I think SCOTUS right now, in fact, I'm pretty sure SCOTUS right now has a very important Fourth Amendment case. It's not a tax case, but it has to do with probable cause and the ability of federal agents to require people to hand over their passcodes and all of this stuff. So this space is being looked at by the courts, but we also know the courts always lag years, if not more, from where the reality is on the ground. Last comment on this, and I'll move on. I think I don't know what the word is. It's just shocking or stunning or worthy of being aware that the IRS and Homeland can literally go on to the commercial markets and obtain taxpayer information. Yes, that information may have been obtained by private actors, so one can make the argument they're not subject to the Constitution, they're not subject to the Fourth Amendment, they're not subject to other strictures. But the fact that the government's out there getting the benefit of that information raises some complicated issues. So expect more.
Jorge, I suggest you can call it Big Brother.
I don't want to use that word in this presentation, but this is happening, and it's happening with both Republican administrations and Democratic administrations. This is not going away. This is not a right and a left issue, in my opinion. This is just the reality of how governments are working, and state governments are doing the same thing, including so-called red states. So this is out there. Government authorities are using this data, and people should be aware, because us lawyers should be aware of this. Anyways, offshore assets is very, very important. I'm at 4:02. Let me pause there. If anybody needs to go, they could go. I don't know what I should do here, Jane, Annabelle. Should I just wrap it up with a few practical thoughts, or what should I do?
Yeah, I think, I mean, you have a couple of minutes, so obviously it's 3 minutes past your deadline, but I wouldn't stress about it. If people have questions, feel free to answer them, or, any sort of final thoughts, really.
Okay, I'm gonna just fly through some of these, and if anybody needs to get off, get off. If anyone wants to jump in and say anything, please do. Otherwise, I'm gonna try to fly through some of these for everyone's benefit. Offshore assets continues to be very, very important. Be aware of that, and for your clients, that is not going away. Offshore assets, offshore bank accounts, and offshore non-monetary assets as well. Steep penalties and very aggressive enforcement. IRS enforcement of virtual assets, conservation easements. I'll just mention that I won't get into how that works because of the shortness of time, but I will say this, and my firm was recently dealing with this type of matter. A lot of people out there will rely on what's called audit risk, but the audit risk is one thing, the tax law is another. And the tax law requires evaluations to meet certain metrics on these things. The Trump organization and the Trump family is being investigated by the New York AG on specifically this somewhat esoteric tax issue. That investigation is very live as we speak, and it has to do with the valuation of assets used by the Trump administration for New York real estate assets. IRS review of PPP and COVID relief fraud. So let your clients know, it's very important that documentation exists for things. Hopefully clients worked with accountants or otherwise to be very careful with this. They are, the new director of the CIA directly told me of criminal investigation at CI that they are going to aggressively pursue this, so be aware of that. Foreign summonses by foreign tax authorities are being enforced by the IRS. Interesting case out in California. You're not going to get those quashed. This taxpayer had a couple law firms, I think, helping, and they lost. If your client has a summons or subpoenas from foreign tax authorities served by the IRS, get tax counsel to assist with that. This is a fascinating one. The Corporate Transparency Act. I've heard almost no commentary on this, whether from the tax community or the non-tax community. This one passed just a few weeks ago. It was tucked away in December of 2020 under the Federal Defense Spending Bill. And this is the most sweeping banking reform legislation, arguably, since 9/11 and the Patriot Act, which we all are familiar with. This is going to require greater transparency than we've ever seen on U.S. shell companies. They're going to have to report the names of the owners of these LLCs, whether in Delaware, Nevada, Wyoming, New Hampshire, pick your favorite jurisdiction, or obviously Florida. They're going to have to disclose. We have not had that. The U.S., as many of you might know or suspect, is probably one of the world's greatest tax havens, ironically. But this is going to, in part, reverse that trend, or seemingly reverse that trend. There's going to be stiff penalties if these LLCs and other entities don't disclose this information. Again, this was not included in the tax legislation we normally see, but it's out there and it's law. There's going to be whistleblower awards. That has also been a trend, both on the state side and now on the federal side as well, the last couple of years. Companies have to be careful of they have exposure with this. Their whistleblowers can receive huge payouts. So basically, this is going to allow DOJ and other authorities, state attorney generals, to weaponize this information. Comment to those colleagues who practice, in real estate in Miami, New York, San Fran, LA. This is something to be aware of for sure for your clients. International Fraud Enforcement is a new office. Again, very important priority of the IRS, working with all of these AI and data analytics and with foreign jurisdiction partners. This year's filing season begins on February 12th, so it's a little bit later. But there is a pushback by the tax return community to push that back. So we may have something we saw last year. Remember that instead of April 15th, it was, June 15th or June 30th. So we may see something like that again. I know the commissioner has expressed openness to that. International, I'm just going to say taxation of the digital economy is red hot. This is the EU and other countries in Asia want to go after Facebook and Amazon. What this is really about, for you non-tax people in the audience, is really what I was saying before, paradigm shifting. This is paradigm shifting. The current international tax order has relied on, the residency-based taxation, which is usually not worldwide, or territorial taxation, which, as the word connotes, is taxation based on values earned in specific jurisdictions. Technology has upended everything, including taxation. And what this is really about is a reordering of the international tax system itself. The arm's length model, many of you have heard that term, that has to do with, the movement of values between subsidiaries or between affiliated taxpayers to basically shift profits to different jurisdictions legally. It's not unlawful. Well, there are many, many unlawful instances of that, but that's a separate conversation. But I'm talking about the lawful planning around this. It's bread and butter. So the digital economy is the taxation of the digital economy, with the OECD being at the forefront of this issue. France just imposed, there's been a very interesting back and forth between France and the US on this issue, and the US threatening to impose non-tax tariffs over basically, France's right to tax digital income. So very interesting issues of trade and national sovereignty with all of that. I will say this is one of the few areas there was bipartisan consent. Not everything was black and white or red and blue these last 4 years. This was one of those areas where Democrats absolutely supported, in large part, the former Treasury Secretary's efforts on this. So we'll see. It's very interesting to see what the Biden team will do with digital taxation. But my prediction is overall, working more with with the OECD and basically coming up, because the tech companies in the U.S., Amazon, Google, Facebook, etc., they really prefer, from a lobbying perspective, they rather there be a global set of rules, or more or less a global set of rules, rather than ad hoc patchwork approach to that. So we'll see more on that moving forward. TCJA, we're going to be seeing legislation on that. SALT, very unique considerations in SALT that simply do not apply in the federal tax arena. States have to, for the most part, or universally, have to balance their budgets. States, unlike the Fed, they can't just print money to cover debt obligations or to cover new or current spending obligations. States have great latitude, as many of you know, under our federalist structure to design and structure their tax systems however they want within federal constitutional constraints. So a lot of dynamism in that arena. Wayfair, that continues to be big. I'm not going to cover that, but you all know Wayfair, many of you know Wayfair overturned SCOTUS, U.S. Supreme Court precedent from 30 years ago, requiring physical presence for states to impose certain use tax obligations on out-of-state vendors. That's going to continue. Marketplace facilitator laws. That's basically going after the Amazons of the world and Etsy and eBay and other marketplaces. And here's a very interesting observation I'll make on this. As I just mentioned, at the international level, there's tectonic plates, there's paradigm shifting taking place. But the reality is that a lot of these concepts already exist in the state and local tax arena. And typically, again, a lot of my colleagues that only practice in federal tax may not necessarily know that or may have a vague sense of it. That's fine. But the reality is that the states have a lot of the concepts, whether you like it or not, that are being looked at in the international tax arena. So, when people say, well, that's outrageous, right? How can France tax Amazon on what France thinks is a fair, tax cut of Amazon's revenue from customers in France? Well, states already do that. For the most part, each state is different, and some states don't have clearly defined laws on what's called marketplace sourcing or sales, single sales sourcing. Here you see this map of the U.S. You see how many, and this is even outdated. I apologize if anybody sees the state on there. That should already be yellow. But basically, you see what's happening. It's yellow. It's not red or blue, folks. It's yellow. The states are moving to this, whether it's Texas or Kansas or it's New York or California. Should I continue? Should I stop? I have a few more slides. What should I do here?
I would probably call it for the day just because of timing. I know other people have to hop off, and a couple people already have. If it's okay with you, I would love to have your slides up on the INBLF website or, distributed to people who attended this webinar so that everybody can get all of the information that you wanted to share today. We can talk about that offline as well.
Possibly.
I don't know if
what else? I'm sorry.
No, it's okay. I was just going to say, if other people have any other final thoughts or questions that they want to share before we wrap up, I would say speak now or forever hold your peace.
And thank you, Annabelle. Here's one thing I'll say. Maybe what I'll do is, if there's interest, and I'll coordinate with you and Jane and Arnie and others, but maybe what I'll do is I'll do a separate presentation later on down the road just on this stuff here, because it's quite a bit. The SALT stuff, there's some SCOTUS cases pending review right now that are potentially big. And I definitely wanted to cover some practical considerations for colleagues to be aware of as we go through the tax year. But yeah, if anybody has any thoughts or comments right now, feel free to chime in.
Great job. Great job. I know how much work these things take. Thank you very much. Hope to meet you someday.
Yeah, and I'll add that we'll based on the slides you just flipped through, we need another sort of practical presentation, and I'd certainly encourage that and coordinate with Jane and Marcine and Larry to sort of get that on the table. So we'll have that later in the tax year.
Thank you, George. This is George from Miami. I'm a real estate lawyer. I would like, for the next one, some discussion on domestic transactions by foreign companies or foreign individuals, and whether the new tax laws will encourage or discourage the same.
Excellent comment. Thank you, George, for that.
I also want to add
that. I'm sorry. Go ahead, Arnie.
I also want to add a big welcome to Takayuki, who is in the middle of the night. And he's a new member in Japan, and he has participated in the wee hours of the morning. I don't know how you sleep or get your rest, but I want to welcome you, and we look forward to more participation. And if there are issues with your clients and your practice related to tax issues or other things, let's have a dialogue, and we can make sure that we can, increase the participation, because you have already established yourself as one of the strongest participants in these INBLF programs, and I welcome you.
And then our next presentation is on March 4th with Deidre De Niro from the Florida chapter, from the Miami chapter. Otherwise, I think we will end this presentation here. I want to say one more massive thank you to Jorge for a brilliant presentation. It seems like we definitely need a follow-up, so we will be in touch. And I hope everybody has a lovely weekend, and we will connect again soon.